Good afternoon, everybody. This is the Market Huddle with Joe Lucey. He is out of the office today at a seminar, so you get yours truly, Ryan Dillon. I'm a financial advisor here at Secured Retirement. I hope everybody had a great weekend. It was a beautiful weather weekend, and I hope people were outside and enjoying the dog days, the end of summer here. But got a good show for you today. We're going to talk about a few things. As you can see on the title here, 6 strategies for a second half of 2021 that could exponentially grow your retirement savings. So next year, just some normal disclaimers. The information and opinions are subject to change without notice on these things. This information and opinions here that we do on these shows are not meant to be specific recommendations. It's more of a chat. It's more to give you something to think about. It's not to solicit or buy any sort of securities. Just to be some general guidelines, to think about. Anything of a specific nature, obviously, we want you to contact one of us, your financial advisor, Joe Lucey himself, to really dive in and analyze any sort of questions we've got going. But again, let's get going here with the 6 strategies we're going to talk about today, second half of 2021 to grow your retirement. First one we're going to talk about is creating a bulletproof income plan. To kind of back up here, the world's been in turmoil over the last 18 months. In fact, even this last weekend, if a lot of you guys saw the news, what's going on in Afghanistan is kind of nuts. But, amidst all this turmoil, the stock market seems to be kind of bulling, forward on this stuff. Fortunes have been won and some, obviously the market, some have been lost. So what will the second half of 2021 bring? As you saw, there's potential threats, but there's also opportunities out there in your retirement savings. What are some of the actions you could be taking from now until the end of the year that could help you get to, that much closer to retirement or, maximize the retirement plan you're already on? So mid-year is always a good time to kind of pause and reflect on and take an inventory of your financial position. This isn't about, how much money you've saved or how much, returns you've gotten through the year per se. But it's more to just kind of reevaluate your risk and where we're taking sources of income and things of that nature so we can make sure your plan is lasting for the long term. As we saw, stock markets are at all-time highs. But here's kind of some of those things coming in. We have soaring inflation. We have the higher threat of taxes coming down the line. We're throwing, again, with the infrastructure bill. I know it's still being decided upon, but I'm sure they're going to ram something through here that is going to just compound what we've done the last 18 months here with throwing money at the economy. So we're in a lot of uncharted waters here, and it takes constant updating and looking at your plan here to, just make sure those retirement savings are in. So, that bullet income plan, again, we're in record low interest rates, and those are forcing many retirees to look beyond the traditional savings accounts, CDs, bonds that they're investing in. A lot more of our retirees right now are investing more in stocks, which is increasing their risk in search of yield, right? And at that stage of the game here in some of your retirement plans, is that where we want to be? So we got to constantly reevaluate where we're pulling our income from. For the first time in over a decade, inflation is making a huge comeback. What's even more alarming is that inflation is accelerating on a month-by-month basis starting in January of 2021. So, retirees are kind of stuck in a rock and a hard place a little bit. Invest more in the stock market, put more risk out there, or do you put it into a CD or a cash account where you're effectively losing money with the inflation we have right now. So, you got to have a little bit of both, and you got to be really diversified is the nature of the game here. But again, you can create a bulletproof income plan by diversifying your sources of income, including those stocks and more. We're trying to go into that pay dividend stocks, going into mutual funds, going into rental properties, or possibly taking a look at REITs here. Making sure that we have other sources of places here where we can pull out income during turbulent times like this. Annuities is another great way, huge in income plan and inflation hedge with some of the bigger companies we use. So diversifying your income provides more flexibility for retirees. It provides you with more choices. And if you're just stuck taking from one account, we're at the will of what happens in the market and things of that nature. So that's what we try to really build with your income plans here is, multiple sources at any time during your retirement, we can kind of build and let grow. And then we'll start taking from here and let grow. And if it's tax advantage or not. But it's doing that diversification way is a surefire way to hedge against the inflation we're seeing right now. Segueing into our number 2 strategy here again is let's create a hedge against inflation here. Let's talk about this. We're seeing, inflation here that we haven't seen for the first time in decades. Rates are continuing to decrease every month. If you're not worried about this and, talking about this with one of your advisors that we have here, I think it's a huge mistake because right now you can make some changes to combat that inflation, hedge against it, start pulling out where things are better in an income plan right now. So it'll reduce the inflation risk in your overall portfolio if you begin looking at it and talking about it right now, especially because buying power, as you know, is dropping significantly on the dollar bill. Just to give you some stats and numbers here, inflation rate has increased every month this year, starting at 1.4% in January, 1.7% in February, 2.6% in March, 4.2% in April, May 5%, and June 5.4%. You guys see the trend there? It's going up and up. Again, now you're looking at this year over year. So May and June, we're kind of taking COVID numbers in there. Keep that, in mind that these numbers are inflated because we did go through pandemic, but they're still concerning and still cause for pause. There was an article in the Wall Street Journal, I believe, an inflation expert, Peter Schiff. He said prices could be north of 20% in 2020 alone. On top of that, if you look at gasoline, food prices, some of the other sectors that we live in and have to touch on a daily basis, such as groceries, gas, things of that nature, you're looking at gas up 50%. So, those numbers here in some of the sectors in groceries and things of that nature are compounding what just the normal inflation rate is. Can get really scary, and the purchasing power of your dollar is going to go down exponentially. And you put that over a 10-year period. I believe I saw a UBS graph on purchasing power, and they say your purchasing power over 10 years in inflation like this is going to be down almost 50%. So the dollar will be worth kind of 50 cents in that time frame in about 10 years in retirement plan. So again, building a diversified portfolio, building in annuities, something that hedges against inflation, something we need to be talking about on an ongoing basis as we move forward. Take advantage of tax planning, Mr. Tax Man there. We want you to keep your money. That's one of the big philosophies here at Secure Retirement is every meeting, if you guys have known, if you're with us, we're looking at taxes every time. With every decision we make, we're analyzing your tax return and things of that nature. You probably don't realize it, and most of our clients do right now after they've been educated and they've been through a few meetings of this, but you have more control over your taxes in retirement than you do in any time in your life. If you don't take these tax planning strategies, if you're thinking about retiring or pre-retiring, you could be forced into a higher tax bracket down the road. When RMDs and things of that nature come around, you could have a massive tax bill. Having a proper withdrawal strategy from your IRAs, 401ks, tax deferred type of accounts in your retirement here, and especially since taxes are at 40 years lows, you can definitely maximize your tax planning here with just some very simple, straightforward advice from the advisors here to build out where to pull this at the right times in your retirement plan. It's giving you greater flexibility now and in the longer term of your retirement. But, I want to see a show of hands. Do we think taxes are going to go up here in the future? What we here think they are. Lowest it's been in the last 40 years. Between the trillions of dollars we've spent for COVID and still spending for the COVID, it seems like we're just pushing the can down the road there. Now with these infrastructure bills, unfunded or kind of lowly funded Medicare and Social Security planning, skyrocketing national debt. I don't know, guys. I think, and gals, taxes are going to go up. What do you think? In fact, the Wall Street Journal again came out and said this, I believe it was last week in an article, that the White House budget team currently is looking to shake revenue out of every available American taxpayer. So when they said under $400,000, don't worry about it, you're not going to be taxed. That simply is not true. They're looking at tax revenue from every position. Nobody is safe here, and we all have to be diligent in looking at it. Okay. Hope we got us back here. Sorry, I think I jumped off the website here for a second, but taxes are going up. Plan with us on every meeting. Let's talk about it and things of that nature. Our next advantage here or strategy to get going is, make a strategy for Social Security. I'm going to turn on my webcam here. It looks like I lost us. Again, some of you are on Social Security right now. Some are talking about it. We do a lot of bridging tactics in Social Security if it's the right plan. It's crucial. It's critical. Making sure we optimize Social Security with your income plan. We could leave tens of thousands, if not, hundreds of thousands of dollars on the table here for both you and a wife or a spouse for your retirement. There's no one size fits all strategy. And if you blindly follow some rules of thumb out there that says, wait till you're 70 to maximize it, maximizing is different from optimizing. And when you've got two Social Securities here between, a couple of spouses, optimization is really the track to go. Because as we test and we show you guys and educate you guys about it, you can definitely see the dollar difference in your retirement plans. So again, too, though, in that optimization strategy is the taxes around Social Security. As many of you know, you can be taxed up to 85%. So the money you're counting on in retirement, you're going to pay Uncle Sam a tax bill on 85% of that if you don't build that correctly into that income strategy that we discussed earlier. But the good news is if you do pull this at the right directions, you pull the right levers and you do it the right way, there's ways to reduce or eliminate, the taxes around Social Security. So again, too, also, with not the one size fits all plan, everybody's different. There might be some things out there that the survivor benefits, the child benefits, disability benefits, divorce benefits, and more. Working with your advisor on that, just to make sure we're looking under every rock here to try to maximize and optimize, more optimize your Social Security is the proper way to go about Social Security. Another strategy here you kind of want to look at mid-year throughout your retirement plan is reducing the risk of and update your portfolio on a biannually or possibly a quarterly basis. Again, we're seeing a lot of people are taking more risk than they know right now because they say, boy, I got to go into stocks to get a little bit more return on this. And if you don't watch it, if you're not diligent on it, they look good, but over time you start compounding these risks, and all of a sudden your risk score is getting higher than we'd like to see, and maybe that stage of your retirement plan. So updating and rebalancing your portfolio on a like I said, a biannual basis, at least, is a good, significant strategy to help kind of balance your portfolio, reduce the risk, making it so, you know, you if and when that downturn of that market does come, you're prepared and you can weather the storm. Because I think we all know, and we've been educating this a lot here in our last meetings, or a lot of our meetings, is sequence of returns risks. If you retire in a down market, or if you begin retirement when a market starts ticking down, you could lose 2/3 of your income in your retirement. That can mean, you know, that income plan we put together that gets you out to age 100 suddenly gets you out to age 88, you know, 85. And we have to start, you know, really reevaluating that on a currently basis with the market, how it's doing now, where you're taking income from, and, you know, hopefully saving that nest egg that you guys have worked so hard to build. Again, proper diversification and asset allocation is more as just a simple mix of stocks and bonds and mutual funds. The day of the one size fits all 60% stocks or 40% bonds, or flip side, you know, it has kind of gone out the window. There's a lot more out there that you can utilize. And bonds right now just aren't producing. They're not bringing those yields in that we need to build that income plan. Whereas, you know, 5-6 years ago, you could really live on that fixed income of some of these nice bonds and things of that nature, plus Social Security, and be pretty set. That's just not the case anymore. You know, some people come in and use the strategy. I'm gonna, I think it's take my age minus 100, and that's the sort of percentage I should be in stocks. Those tried and true strategies just you know, are fun to talk about and play with, but they're just really not going to get you home to having a long, successful retirement strategy anymore. You really got to lean on your advisors. We have a lot more tools. You have a lot more tools at your disposal to build, you know, an income plan, to build some returns that without increasing your risk, that are at your disposal now, that you know, some people just don't, you know, really realize or notice about or even discuss anymore. So always good to reduce the risk. Take a look at your risk score when you're at meetings with us. Is that right to you? Does it feel right to you? Is it making you apprehensive? And that's what we're here for, and that's what we love talking about. The sixth strategy here is kind of a midterm take a look at your healthcare plans, is to take a look at your healthcare plan. As you guys have all known, and you're probably seeing on a day-to-day basis, healthcare has been steadily increasing for a number of years. If you don't have a plan to talk about spending for healthcare or long-term care expenses, your medical bills could eat away at a huge chunk of your nest egg in retirement. Recent reports are estimating that an average retiree at 65 years old and older should have between $300,000 and $325,000 set aside just for medical expenses. That does not include the cost of long-term care. Okay, so again, when we're building retirement plans for our clients here, it's like building a retirement cake in a sense. There is a recipe here that we've got to build that handles Social Security, income planning, healthcare expenses. Where are we taking this money from? Where are we pulling the taxes from? You put it into, you know, that bowl. You got to mix it all together, and we got to build you guys a nice retirement cake that you can live on for the rest of your life, and be able to spend in confidence and be able to do the things you want to do. It's not hard. It just takes some analysis and some testing and a lot of discussion with you guys to put together. But as we know, people are living longer than ever. There are some recent reports now that that number is kind of flattening now. It's not increasing as it has been the last 10 years. the longevity in people, which is interesting. We'll keep walking at, but medicine's getting better. Doctors are getting better. People are living longer. That's why we believe in longevity here. And that's why we build your income plans out to 95 to 100 years old minimum. We want to make sure you can spend in confidence, be able to provide some funds to your family when you do pass on, things of that nature. But we're big believers in people are living longer. And that planning and the cost of healthcare and long-term care can be, manageable, very manageable and somewhat predictable. For example, health insurance premiums will account for a majority of your healthcare expenses. And those can be easily planned for and built into your income plan. And we do that with a number of our clients that are in the, mid to probably the mid of the later years of their retirement planning. We've done really good about building a nice little healthcare nest egg there. Again, too, if you also been through our income planning, our Roth accounts, we like to build those right now, tax advantage. We're at the lowest tax rates in 40 years. We're building those Roth accounts. We think Roth conversions are a great idea right now while we're in 40-year lows of tax planning. But again, those Roth accounts that we use are the last accounts we want you guys to touch most times throughout your retirement. The reason being is when those healthcare costs do start later in your retirement, possibly pulling out of a Roth is a good tax-free medical expense when you're going through this time in your life, or you've got to pay for healthcare or something to a better quality of care than Medicare might provide. If we're going into a assisted living or we can't perform 2 out of 6 ADLs and we need some help to come over to our house to help us just kind of get through daily living ideas, pulling from a Roth account, one is a tax-free way to pay for that. And then again, in April, you don't get a tax bill from, Uncle Sam that says, hey, you had to pull a big chunk out of your IRAs to provide for some health care for you or a family member. And now here's the taxes on top of that. So, the pain of health care and some of these things we have to deal with in our life, to then get a tax bill in April about it. I don't know, not the best story in the world, but we do feel that pulling out of that Roth is a good tax-free example of paying for those healthcare expenses. We've touched on now, 6 strategies here. Again, we are always available to have a review with any of these strategies that you've had. Our number is on the phone. Our number is on the computer screen right here. Again, with the end of the year coming up, we want to be talking about Roth conversions. We want to talk about tax efficient strategies. Make sure your income plan is set to do the long haul. Again, looking at inflation right now, it's been going up month after month, higher and higher numbers every year. So your purchasing power is something that we need to key onto and at least have the discussion with you to make sure everybody's there. So with that, if anybody's got any questions here, we can hopefully hit those. If not, I'm kind of running long here, and you guys have a pleasant Monday. Have a great week. Sounds like it's going to get hot again on us for a little while. It's been a great summer. We look forward to seeing any of you guys here in the near future. If you haven't seen, we've started up the Lunch and Learns again. Next Monday is going to be with a columnist and a radio host, Patrick Ricey. He's been in the Minneapolis-St. Paul area for about 30 years talking about sports. With these Lunch and Learns, we don't want to do everything just financial. We want to bring other facets of life that you might be dealing with. This Monday, the 23rd, will be sports, but we're also going to be talking about health and wellness. Me being kind of an outdoors guy, I'm trying to get Joe to bring in maybe some fishing guides or some outdoor living or hunting guides or things of that nature too, but nothing to try to diversify our own lives and not just talk about financial planning every time we do a Lunch and Learn. Again, it was a pleasure being with you today. Joe will be with us, I'm sure, next week, but everybody have a happy, healthy, great rest of the week, and we will talk to you all very, very soon. Take care.